Hi, I'm Toby.
And I'm Nick.
And welcome to the Pure Property Podcast from Track Capital, where we talk about all things property and property investment. The aim of the podcast is to give you our industry insight and knowledge in bite-sized chunks to help you invest intelligently. So this week we have had another launch of the latest home chat report. And Nick, I know this is one of your favourite things to look at and go over. So what have you found interesting in this month's home track report?
Yeah, so in terms of for those that don't know, the home track report or the UK House Price Index is basically a rolling capital growth rate of the top 20 cities across the UK. So basically, it gives you a benchmark to compare different cities and just see how they're performing consistently. It's the most up-to-date data and what we encourage people to review. In terms of the performance, very much along the same lines. The best cities in the country doing Liverpool 6.3% growth up to March 21, and Manchester topping it at 6.5% growth. So your typical cities, regional cities are performing well. So one of the points that really stuck out to me was the stat that in the first 15 weeks of 2021, the value of new homes that were sold in the country would double that of the same period in 2019. So it really goes to show you when people say, oh, the market's busy, it's not only the residential market, but it's the new home market as well. And we're talking double of where we were a couple of years ago. So things are continuing as they have been over the past few months. Momentum is still very strong in the market, 6.3, 6.5% growth rate. So, yep, all positive at the moment.
Yeah, and the question I get asked quite a lot at the moment from investors and people in the property industry is what's driving this? What do you think's driving this? And the home chat report clearly does spell it out. It's the fact that demand has massively increased and supply has actually decreased. So there's always been a supply and demand imbalance, and it's got even larger as it stands at the moment. And that is really, really driving those prices up. And although I see it may, I say steady, it may slow down and not be as aggressive, but that isn't looking like it's going to change anytime soon, because I don't see houses being built magically to sort of please the demand, and I don't really see too much demand coming out of the market. So it's going to be interesting to see where we end up at the end of the year. But yeah, as it stands at the moment, property market is very positive. And some may say that all these years of asking where we're at in sort of the property cycle, as you call it, this may be the start of the boom phase. So it's now a very good time to sort of get into the property market before we reach the top of that boom phase, which could be a couple of years off.
Okay, good stuff. So let's move on to what we're speaking about today. So we are looking at buy-to-let mortgages specifically today. So as we touched on last week, running through the differences between residential and buy-to-let mortgage products to give investors an understanding of where things might be slightly different. So, Toby, do you want to kick us off with the basics and run through, what exactly is a mortgage, etc.?
Yeah, definitely. And before we start this podcast, we just want to make everyone know we're not mortgage brokers or financial advisors. This is just our understanding, and we're giving you our input. So just wanted to say that before any mortgage brokers or financial advisors tell us to stop giving advice, just to cover ourselves. But what is a mortgage? So the actual definition of a mortgage is a legal agreement by which a bank, building society, etc., lends money at interest in exchange for taking title of the debtor's property, with the condition that the conveyance of title becomes void upon the payment of the debt. So, in simple terms, a lender gives a borrower a sum of money to buy a property, takes a charge against that property as security. When the money is paid back to the lender, the charge is removed, and the lender will usually charge a rate of interest for the amount of money that they lent the borrower. That's it in simple terms. So, Nick, why don't you sort of bring us into the main differences between residential and a buy-to-let mortgage, if you start with residential mortgages?
Okay, good stuff. So, firstly, narrowing things down a bit further then. So, what exactly is a residential mortgage? It's a lending product designed for people that are residing in the property, i.e., when you buy somewhere for yourself to live in. So, it's ultimately for those that wish to live in the property. What you'll see normally is that when you're paying back the mortgage, you're typically expected to pay back the value of the property and the interest on a monthly basis at the set rate which you've agreed to. So, as we'll touch on later, this can differ slightly for buy-to-let mortgage products, but with a residential mortgage, typically you're paying back the balance of the home plus the interest rate accrued. Now, and one of the big differences is the loan to value on residential products. So you might see this referred to as LTV, which effectively means how much of the property value the lender will lend you. So with residential projects, it can go up to 95%. In other words, you would need a 5% deposit and then you would be lent 95%. So, yeah, higher LTVs is definitely one of the main differences. And when the lenders are assessing you in terms of your ability to get the mortgage, often the amount you can borrow is based around your income, your personal circumstances, credit history, etc. So it's very much focused on the individual in question, obviously, as they will be the ones expected to pay back the funds. So hopefully that gives a quick run through of the residential side of things. If you want to crack on with the buy to let mortgage side of things, Toby.
Yes, so a buy to let mortgage is used to purchase a property with the purpose of renting it out. The majority of buy to let mortgages will be interest only repayments. So, this is where you pay only the interest and you don't pay down the loan. This makes the monthly amount paid back to the lender a lot lower. This means that the landlord gets profits from the rental income. They will tend to have a lower loan to value, and you will average that they start around 75%. There has been known to be 80% prior to the coronavirus pandemic, but once the pandemic hit, loan to values were taken back down around 60, 65, and then sort of gradually back up to sort of your normal average of 70, 75%. But yeah, they tend to start around 75%. Interest rates, they can be slightly less favorable than residential interest rates. That's because they're seen as riskier by lenders, because there is no certainty that the property will be occupied all the time and that the tenant will actually pay the rent. So they're deemed more riskier, hence the slightly higher interest rate. Lenders will also consider the potential rental income when assessing the affordability and the criteria for them to lend to a borrower. So they don't just take into account the actual borrower's circumstances solely, so what they're earning, etc., etc. They will also look, and this is obviously lender dependent, but they'll also look at the rental income as well. So it can mean that you can afford sometimes slightly higher properties than you would if you were buying for yourself, because you can take into account the rental income that you would receive. Now we can go on to repayment mortgage, as we've mentioned with residential, versus interest only, which tends to be the case for buy to let. So, Nick, why don't you head us off with that one?
Okay, good stuff. So, yeah, as we touched on earlier, there's typically two types of repayment options that lenders will accept. So, yeah, repayment or interest only. So, ultimately, a repayment mortgage will typically be a higher monthly amount, as ultimately you're paying back the loan for the asset or the property as well as the interest. So, you'll be expected to pay back more on a monthly basis, which can minimize your potential cash flow. Interest only would obviously be a significantly lower amount because you're just paying off the interest, which is accruing on the balance that you've borrowed. So, what we tend to find is this is ideal for improving your cash flow, i.e., your costs are going to be less on a monthly basis. So, you're going to be left with more in your pocket if you're operating a buy to let model. So, that what that means is most landlords or most investors will typically go for an interest only option in terms of their repayments, and this is typically what we recommend to investors. You know, it can ultimately minimize your exposure, your risk, and increase your cash flow, and ultimately your return on cash invested figure as well. So at the end of the repayment mortgage, you'll have the debt to pay off, and you'll own the property outright. At the end of the interest only mortgage, the owner is required to repay the mortgage in full. So if you borrowed £75,000, for example, for your buy to let mortgage, at the end of the mortgage, you will owe the bank £75,000 still, because you've ultimately be paying off the interest rate. So you can typically repay this capital by selling the property itself. So hopefully that's a quick run through of the repayment aspect versus the interest only aspect. As we say, for investors, typical buy to let landlords, you want to be going for the interest only to minimize your potential exposure and increase that cash flow. So hopefully that gives a good summary.
And I think next we can go on to what are the advantages of using a buy to let mortgage? Because sometimes we get people that have the cash to buy outright, but they'll still buy using a buy to let mortgage. And some people might ask, well, what's the point in that if you've got the cash, buy outright? But there are actually some benefits to utilizing the leverage of a mortgage, of a buy to let mortgage. So one of the main ones is you can become a landlord and investor a lot quicker. You don't, if you've got a property that you need to buy for investment and it's 100 grand, it's going to take a very long time to save up £100,000. But if you only need to raise 25,000 for a 25% deposit, that's going to be a lot quicker for you to save up and get hold of, and that will enable you to buy that property a lot quicker and then become a landlord and investor and start making some money of it. So it can get you on the investment ladder a lot quicker by utilizing a buy to let mortgage. It can increase your ROI, which is your return on investment. Now, a lot of people say, well, how is that the case? The best way is just to give an example. So if you were to buy a property for £100,000 cash outright, and the rental income for that property is £600 per calendar month, then each year you're going to earn a nice £7,200 per annum. Now, remember, these are just base figures, so just bear with me on that. That will give you a return on investment of 7.2%. If you bought the same property using a buy to let mortgage and only had to put in 25% as your deposit, because remember, we're getting the bank to finance the remaining 75% by a buy to let mortgage. So you put in £25,000. Let's say the interest rate is 3% for that specific mortgage product. So your interest rate's at 3%. That means on an interest-only mortgage, your yearly income will be the £7,200, which is your rental income, minus your mortgage costs. So in this instance, it's £2,250. That leaves you with your net income of £4,950. Now you might say, well, hang on a second, I'd rather have £7,200 in my pocket than £4,950. Clearly, cash is the best way to do it. Well, no, because when we look at the return on investment, now remember, we are investing, so that's our main focus. Your return on investment with the 4,950 utilizing the mortgage is 19.8%. That's in comparison to your 7.2%. That is a massive, massive jump. And that is effectively because you've put less money in and you're getting returns. So that is effectively your return on investment. How did we work that out? Well, just so you know, for the calculations, your £25,000 deposit divided by your net income times 100. That's where we got 19.8%. So that is great. So you can see how your return on investment can massively increase by utilizing a buy-to-let mortgage. Then it can become even better from a return on investment point of view if you then take into consideration capital growth or capital appreciation. Because if the property price goes up, it doesn't matter whether you bought it outright for 100k and it goes up 20 grand, and you bought it with a mortgage and it goes up 20 grand, you've still made 20 grand. So again, your return on investment by using a mortgage is much higher because the capital growth has jumped up and you put in less money. So that is another great advantage of using a buy-to-let mortgage. Another one, so this could go for the person if they had £100,000 cash to buy that property. It can then enable them to buy more properties, so their money can go a lot further. So the 100k property, if they rather than bought it outright and they said, well, actually, I'll take 25 grand deposit out of my 100k, I can then buy 4 properties. Okay, we're not taking into consideration all the other costs, but again, these are just a simple example. But yeah, 100k, divide that into 4 properties is 25k a pop. So you've then got 4 properties with 4 deposit levels of 25%, which we know is doable. So then you've got 4 properties worth 100 grand rather than the only one. And then again, if we have the capital growth added into that, instead of the one property going up 20 grand, you've now got 4 properties going up 20 grand. So you've made 80 grand from the same amount of money in capital growth rather than just the 20. So they're the main advantages of utilizing a buy-to-let mortgage as an investor. So yeah, that's sort of all we'll go into, because there are a few others and you could probably go on for quite a while about the pros and cons, but yeah, they're sort of the main advantages that we wanted to highlight.
Perfect. Good stuff. And hopefully those, real life, well, not real life, but hopefully the figures in there really illustrated the benefits of doing so. I always find it helpful to look at cash figures. It tends to get people's attention. So yeah, that was a good summary there. Okay, so moving on, just a couple of bits to think about when you're actually reviewing mortgage products or just in general. Obviously, it goes without saying, interest rates can vary from product to product. So this is going to be different if you're going for a residential mortgage versus a buy-to-let mortgage. And then again, if you're going for a buy-to-let mortgage, if you're buying in your personal name or you're buying in a limited company name, again, that's going to affect your interest rates. Obviously, you want to consider the length of the mortgage product, and if there's a fixed period, or it's when does it become variable, etc., etc. And just the other point, which we do come across quite frequently, investors may just speak to their high street bank, for example, and say, oh, what rate and terms can I get on this buy-to-let investment? So, and just the other point I would stress is that rather than speaking to just your high street bank or your traditional lender you might go to, speaking to a quality mortgage broker who's experienced in the buy-to-let and limited company market in terms of having exposure to plenty of lenders as well, then yeah, we would recommend that, obviously. So it's worth researching, taking the time, speaking to a few. We can obviously give recommendations there as well. We work with a couple of really, really high quality and efficient mortgage brokers. So yeah, hopefully that gives a good summary today. Ultimately there are always risks with financial products, but if you do it right and you get favorable terms, you can considerably increase your return on cash invested. As we've mentioned, in most cases, we find that it's generally better to go for a buy-to-let mortgage than not, especially if you're buying in the middle of the city centre with high anticipated demand and growth rates as well. So, yeah, hopefully that rounds things off today. Maybe, Toby, if you've got any final comments. If not, let us know what's happening next week.
Yeah, no, I think you summarised that well. I think the other 2 points as well with the mortgage side is, yes, they're obviously the risk side, but you have to remember lenders are very strict with their criteria now. So they're not just going to lend a lump sum to somebody who they think is going to be sort of troublesome or run into problems. So they do a lot of due diligence, and they have strict criteria when lending. So if you are passing their criteria, then again, the risk of it all going wrong is fairly low from their point of view, which should help give you peace of mind. But don't get me wrong, there's always scenarios that you can't account for, and yeah, you always have to be careful because you have the final financial obligation of that mortgage. So that's yeah, always something to bear in mind. But next week we're going to be looking at city centre property investing versus commuter belt. So we're going to look at the 2 different locations, the pros and cons for both, and discuss that next week. As again, these are stuff that we have conversations about with our investors. So that's why we thought we'd cover an episode on it.
Yeah, good stuff. And I think that goes for wherever you're based in the country as well. Even if you're looking at, the northwest regional cities, your Manchester, Liverpool, you can compare buying on the outskirts of those cities to buying in the centre of town. Or even if you're in the southeast of the country, when you look at the commuter belt locations in and around London, it should make for a really good comparison. And we can, really go into detail about the advantages and potential disadvantages of each. But yeah, hopefully that's going to be useful.
Yes, I'm sure it will. So that is all we have time for you this week, and we'll see you next week. Bye bye.
Thanks, everyone. Bye.